Now, there's a few things I want to point out with property. It is a long-term commitment. So I want to use myself as an example. I don't know if I intend on living in South Africa in the future. I possibly want to, but I also possibly don't want to. So for me to go and buy property in my personal name, I feel that it's not the wisest decision. And that's why I opted to set up the stokvel that focuses on property. I'm basically mitigating, I'm minimizing that risk of 100% exposure to the property market. So property is illiquid. That means I can't sell it quickly to get cash. So if I only have 150,000 Rand in total, and I put that down as a full deposit, and I need cash after I've bought the house, I need to sell that house or I need to go into debt to raise the capital. So that's what it means when it's illiquid. I can't get cash for it very quickly. I mentioned it's an immovable asset, so it's long term. So if you're confident you're going to be in a place for a long time, then yeah, it might be worth actually going out and buying that asset and using it as an investment. There's a couple of chat boxes here. Let me just see. Sorry about that. J-Boy, yeah, born and bred. Okay, thanks. Chloe, I have a question. Please, I've been saving money to invest for a deposit on a house. However, I recently bought your property ebook and I saw you mention about falling prices. I'm a bit nervous to buy now because interest rates could go up. What would you suggest I do with my capital, and go ahead and buy property or rather put money into equity? Okay, coming out with the big questions already. Well, Chloe, I can't give you financial advice, but and thank you first of all for buying my ebook. I do appreciate that. It depends on your goal. So if your goal was to buy property and use it as a deposit, but now you've changed your mind, there's nothing wrong with that. Maybe wait in cash for another 6 months. Okay, don't be in a rush to go out and buy something because opportunities always come about. So I did mention in the ebook that I believe property prices will come down over the next year by almost up to 30%. So being in cash is not a bad thing in the short term because you can capitalize on any opportunities. Or if you want, maybe take 30% of that capital and put it in index investing. So I don't want to say go and do this, but don't be in a rush to do something that you might regret. Okay, because we are looking at property now, and like I said, it's a long-term commitment and it's illiquid. So you might battle to sell. And when it comes to property negotiations, most people, everyone says offer lower, right? Yeah, that's great. But the person who you're buying from, the problem lies in how much equity. So the problem comes in when the person you're buying from doesn't have a lot of equity in the house. So although I'm giving them a lower price, they're never going to accept it because what they owe on the bond is probably still more than what you're offering them on their property. So there's no way they're going to sell the property and still have debt on their name. So we at that sort of level. So it depends on person who has equity in their house, and that's usually someone that's lived in that house for a long time or in older areas. So I'm sure you read that, Angie, in the ebook. So if you have any questions, just follow that up at the end with me and we'll get into it. So I don't want to spend too much time on that. So back to property. Property is usually a growth asset, guys. So you can benefit from capital growth as the property prices increase and income from a tenant. Again, that's dependent entirely on the economy and perception of that country. Interest rates, inflation can also dictate those prices a little bit, which we're going to get in now. So there's just something I want to point out, that lower interest rates don't make property prices cheaper. It makes the financing costs cheaper. And in fact, when demand, if more people can borrow money, that's actually going to push up property prices because there's more people getting cheaper financing. So the next graph I'm going to show you is property prices, their growth rate in the provinces of South Africa. Now, I think the current inflation rate in South Africa is 4.4%. And we've been around that area under 5% for a while. And you can see there's only 2 provinces in South Africa that's actually offering inflation-beating returns on property. That's Eastern Cape and Mpumalanga. So it's also something to consider what asset class you decide to go for. Guys, I'm not saying property is in bad investment now. I'm just saying you need to understand who you are, what your goal is, and the economy that you are working in. If you look at the interest rates, the historical interest rates of South Africa, you can see that we've been trending downwards for at least the last 20 years. So that means financing costs have been getting cheaper, which is supposed to actually stimulate the economy, because lower rates incentivize people to borrow because the cost to borrow is actually cheaper. But that's been the opposite of what's happening in our economy, which we'll see in a graph shortly. The GDP has actually been going down since the financial crash in 2018, and South Africa is actually very stagnant at the moment. There's no growth, actually turned negative now because of COVID. So this interest graph is very important in my opinion, because like I said, we go through cycles and South Africa reacts to global macroeconomics. We don't set, we react. So if we are faced with a situation where the US starts raising rates, South Africa is going to be forced to raise rates to protect the currency, because that is SARB's mandate, to protect the value of the currency. So it might even be out of our hands. So the question you should be asking yourself now is, have we floored? Can the interest rate still go lower? Will the finance minister or the reserve bank actually want that? Would they vote that at their next meeting? I personally don't think so. I think we've hit the floor and the only place is up from here. So those of you that aren't familiar with interest rates, you get the repo rate, which is 3.5%. That's basically the rate that commercial banks borrow from the Reserve Bank. So we have the central bank, which us as citizens, we don't transact with. We can't go there and take money. Then you have the commercial banks like FNB, ABSA, Standard Bank. They borrow money from the Reserve Bank. The Reserve Bank is the issuer of rands. They actually decide the interest rates. They will lend the money to commercial banks, and then commercial banks will take it and lend it to us. That's the prime and the repo. So commercial banks borrow from central bank, commercial banks lend to us. Now we don't get prime rate. We might get prime rate 1 + 1, prime rate +2, +3. That depends on the individual's own risk profile. And that's determined by education, current employment. I don't know the entire criteria, but those 2 things are considered. So depending on your personal score, that's the rate you'll get. The banks charge that to give themselves leeway and to maintain profits for themselves. I don't really agree with that. They could be structured a whole lot differently. I also believe the future we could eliminate commercial banks completely and directly deal with central banks through mobile money transactions through digital currency. That time there's complete control of the money supply, but we won't get into that. So central banks, commercial banks, us. Now, a very important graph is inflation. This inflation is basically telling you the purchasing power of your rand is becoming less over time. So if I can buy 10 apples today, tomorrow I can only buy 8 apples. That's inflation. Inflation is through the devaluation of our currency as prices go up. So again, if we are net importers of goods and we are buying with rands in foreign currency, we're using our rands to buy goods in foreign currency. If our rand weakens, we need more of our rands to buy that same thing. That translates into higher costs. Again, you'll see that the inflation rate has been coming down. That is why interest rates have been able to come down too, because they usually move in line with each other. Inflation down, you have room to reduce interest rates. Inflation up, not SARS, SARB, the South African Reserve Bank, they will probably increase interest rates to absorb any excess liquidity. And South Africa focuses on austerity, so where they cut costs and they increase interest rates eventually. That's why our economy is flatlined. If we're willing to run inflation hot, let's say if you see this spike over here, based on historical performance or trends that's happened, you'll see in 2004 we hit very low inflation, and then we went through a period of a year or two of high inflation, over 10%. Now, if the same had to happen now, and we currently at 4.4%, we could shoot up to 12.5%. So that means now we're running the economy hot. If we decide to keep interest rates low, that means people are borrowing and there's going to be excess money in the system. So an increase in the money supply. So the cost of things will go up. Now, that's not necessarily a bad thing if you are increasing productivity with it. If you're using excess money supply for consumption, then you're going to run into a problem. But if your economy is producing, if I produce more apples with inflation rising, I'm increasing jobs, I'm increasing wages, and I'm creating a surplus of apples that I can export to nations that are importers. So inflation is not always bad, guys. It depends on the economy. So we could be seeing inflation going up. Depends on a few factors like oil price, if the central bank decides to keep interest rates low. But based on past data, that's not what South Africa does, because they believe in austerity. You'll see shortly what they've done to the economy. The bankers and central bankers and the people in the Reserve Bank that vote and those that make the decisions. So this isn't 100% accurate, so just use it for visual purposes only, guys. But it's just to give you an idea of the correlation between interest rates and inflation. You can see interest rates have been coming down for the last 20 years, and so has inflation. But when we experience periods of higher inflation, the central bank reacts by increasing interest rates. Why? They're absorbing that excess liquidity out of the system to keep inflation down. Okay, because there's more money in the system. Now, you can keep interest rates low and the banks borrow from the Reserve Bank. At the end of the day, the commercial banks need to lend that money out, which is known as the velocity of money. How quickly money changes hands. That is the real thing that causes inflation. If I'm taking my 100 Rand, think of COVID. When things went into lockdown, no one was spending money. So central banks could lower interest rates because there was no money flowing around. So no demand, less supply, which is going to stun inflation. Now, if you had to just open an economy, we always hear about pent up demand. That is the velocity of money, how much money is in circulation, and how quickly people are going to go and spend it. That will influence interest rates, and that will influence inflation, which that will influence interest rates. Because if inflation runs too hot and there's no productivity, then interest rates are going to go up to absorb that liquidity back in. That's the SARB's mandate, to protect currency and to hold the value of the rand. So it's very important, and this relates to property because obviously higher interest rates stuns the demand on property, which means property prices come down. Those that were, I wouldn't say fooled, but those thought that they could afford it at lower rates are now experiencing rising rates. So the cost to service that debt goes up. So that becomes a financial burden. And then I believe there will be an oversupply of people wanting to sell their property with lower demand because we have rising interest rates. And that's going to bring the property market down 20, 30%. So back to Angie's point, Angie or Chloe, I think it was Chloe, that you said that should you wait or what you should do, maybe waiting could be a good idea. Watch interest rates, watch inflation. Again, I went through this now. Yeah, it's just a visual thing that everyone can look at. Basically, the concept is pretty simple. Interest rates up, that slows inflation. There's less velocity of money. There's less money in the system flowing around. Interest rates down, supposedly higher economic growth and faster inflation. You can incentivize people to borrow, but you can't incentivize people to spend. If people don't spend, there's no growth. So just remember that. Interest rates are a tool to manage money supply, and it's a tool that the Reserve Bank has to stimulate the economy